Good morning again to all of our options traders. Well, a question that I get from many traders is they want to know if call options are speculative. And the reason is they'll say, well, some of your videos talk about that they're actually insurance policies because they guard the downside. But by the same token, if the stock makes a small move down, you could lose 100% of what you put into the trade, which now makes it sound like it's quite risky. So which is it? Well, it's a very good question, and questions like these can be easily answered if you understand that there are actually two types of synthetic positions. Now, I've got many videos in this YouTube channel on synthetics. If you want, you can look those up. But the basic idea is that a synthetic position, just like synthetic wool or synthetic oil, is a way of creating, let's call it a man-made version, or we're making something look, act, feel, behave like something else, but we're making it from different materials or different ingredients. And that's really what we're doing with options. There are different ways that we can construct identical risk profiles, but by using different assets, namely stock, calls, and puts. But there are two different versions of this synthetic formula. And if you don't understand these two different versions, you're missing a big part of options and of having a deeper understanding of questions like, are call options risky or are they insurance? So let's go find out what are the two types of synthetic positions. Before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So if you look at some of the other videos that I've talked about synthetics, the basic formula that I use is this one. And here we're just going to say shares of stock plus a put minus a call, we're just going to say equals 0. And by just doing a little bit of algebra with it, you can solve for any single one of these three. So for example, let's say we want to know what a long call is. Well, I've got a short call on the left-hand side. I could make it a long call by moving it to the right. So algebraically speaking, technically speaking, you are adding a C to both sides. But I like to just visualize it as if you're just putting your finger on the C and swinging it over to this side. And when you do, you have to change the sign. So every time you switch to the other side of the equals, in this case we have to go from a minus C and we would have to make it a plus C. So look what we have. Stock plus put on the left is the same thing as a long call. So what that's telling you is that if you own shares of stock and a put, let's say a $100 put, it will behave exactly the same as a $100 call. So the reason that they're called synthetics is that they create the same risk graph. So here we're looking at a $50 call option. There's our bend. We have limited risk to the downside. We have unlimited potential gains. But let's compare it to stock plus put. So look at that. Get a bend at 50. The two risk graphs look exactly the same. So notice that we have created a call option from something else. We've used shares of stock and a put with the same strike as the call, and we get it to behave or act like a long call. So in the business, we would say that shares of stock plus a put is synthetically equivalent to a long call. Now, as a little exercise, you can go back to that previous formula, try to figure out what shares of stock will behave like, or a put, or the short versions. What's a short call? Short shares of stock, short put. You can answer them all by that one simple formula. Now, here's the reason that it works. Let's compare two portfolios, or maybe two different traders. One is holding shares of stock plus the 100 put. This is our synthetic call. And the other is holding the call option, the 100 call. So once again, notice that the strikes have to match if they are going to behave the same. So let's just look at a couple of simple scenarios. Let's say that the stock is less than 100 at expiration. So the call is out of the money, but the put is in the money. So for any stock price below 100, watch what happens. The person who is holding the shares of stock can exercise the put and turn it into $100 cash. The person who owns the call ends up with nothing. But if the stock is above 100, anywhere above 100, watch what happens. The put option goes out worthless, and this trader is just holding shares of stock. So whatever the stock price happens to be, that's the value of this position. So let's just say the stock is at 101. This trader's portfolio or position is worth 101. What's the $100 call worth with the stock at 101? It's worth $1. So you'll notice that they don't equal. We've got a $101 value on the left, but we have a $1 value on the right. So we're saying, well, why do we call these synthetic equivalents? Because they're not really the same. Well, here's why. When we talk about synthetics in the options world, we're talking about tracking the changes. So for example, let's take a little more detailed look. In black, we have the trader who is holding the shares of stock plus the $100 put. In blue, the trader that owns just the $100 call. So let's say the stock is trading at 85. If we're at 85 at expiration, the $100 put is worth 15. There's $15 of intrinsic value. So notice that 85 plus 15 gives this trader's total value 100. But the call option with the stock at 85, this $100 call would be worth 0. So again, they don't match. 100 is not equal to 0, even though we're saying that they are synthetically equivalent. If the stock is 90, look what happens. Stock's worth 90, $100 put is worth 10. Together, they add up to 100. $100 call is worthless, expires out of the money. Look what happens if the put goes out of the money, let's say at 105. So with the stock at 105, the $100 put is worthless. So the total position is worth 105, but the call is worth only 5. So again, they don't match. 105 does not equal 5. Why do we say that these are synthetically equivalent? Well, the reason is that in the options world, when we talk about synthetic equivalence, we're normally talking about the changes in these values, not the total values, but the changes. So for example, let's say when the stock moves from 85 to 90, this person's portfolio went from 100 to 100. That is a change of 0. What happened to the $100 call? It was worthless here with the stock at 85. It's still worthless. That's a $0 change. It didn't change. Still worthless. But what would happen if we looked at, let's say, the next set? Stock goes from 90 to 95. Well, this person's portfolio is worth 100. It's worth 100 at 95. So the change in those two is 0. The change in the call, 0. The call expires worthless with the stock at 90 or the stock at 95. So you'll see that no matter what you pick, let's say if it goes from 95 to 100, this trader here that owns the stock plus put has a portfolio worth 100 with a stock at 95. It's worth 100 if the stock is 100. That's a 0 difference between those two. And for the call option, it expires worthless at 95. It expires worthless at 100. So the difference between those two is 0. But now let's look at what happens if the put goes out of the money and the call goes in the money. Let's say the stock goes from 100 to 105. Now the trader that owns the stock plus the put has a portfolio worth or moves from 100 to 105. That's a change of $5. What happened to the call option? Well, it was worthless with a stock price of 100, but if the stock is 105, it's worth 5. That's a change of 5. Do you see how the changes are matching? What if we go, let's say, to the next one, from 105 to 110? This trader's portfolio, stock plus put, goes from a value of 105 to 110. The change in that portfolio has gone from 5 to 10. It's an increase of 5. Look what happened to your call option. With the stock at 110, the $100 call is worth 10. It was worth 5 down here with the stock at 105. So the change in the call is the same. Even though the portfolio balances aren't the same, the call is worth 10, stock plus put is worth 110. But do you see the difference when we're talking about the changes? That's what we're talking about when we use the word synthetics in the options market most of the time. And what we're looking at here is actually called a mimicking portfolio. That's the formula stock plus put equals call, for example, or stock plus put minus call equals 0. That's a mimicking portfolio. And so call options mimic long stock plus put. They do not exactly mirror it. So think of it just like a parrot might mimic speech. It's not really speaking, but it just kind of looks like it. And that's really why they call it a mimicking portfolio. It's not intended to be exactly the same level as the stock plus put. It's intended to mimic it in terms of the changes. So call options track the changes of the stock plus put portfolio. That's really what we mean when we say that stock plus put is a synthetic equivalent of a call. Those call options are just tracking those changes. The call options do not track the total value of the stock plus put portfolio. Well, that brings up an interesting question. How can you make a call exactly mirror stock plus put? Well, to do that, we'd have to add a bond to the equation. Now, this bond we need to make equal to the exercise price or the strike price. So if we have a $100 call, we could buy a $100 face bond. That just means that at maturity, whether it's in 30 days or a year from now, it will be worth $100. Because of that, it's going to be traded, at least in most cases, if it's a discount bond, at a discount. So we might pay $95 for this bond and then have it mature to $100. But that's the idea. We need to front some cash, kind of think about putting it into a T-bill or a savings account that's going to mature to the exercise price. And so the point to understand is that if we want the two portfolios to exactly mirror each other, we need to end up with, in this case, $100 cash at expiration. Whatever the strike is of the option that you're looking at, we need a bond to mature with that same value. So now watch what happens. Here's our stock plus put over on the left. Here is the $100 call plus a bond. Now let's say that the stock is below 100 at expiration. Well, as we saw before, the stock would be less than 100. We could exercise the 100 put and get $100 cash. What happens over here? Well, with the stock below 100, the call expires worthless, but we have a bond equal to the exercise price, equal to the same price of the put. And so now this trader is holding $100 cash, just like this trader. What if the stock is greater than 100 at expiration? Well, now the put expires worthless, and the stock is the only thing providing value. Let's say the stock is trading for 101. Well, this trader's portfolio is now worth 101. What about the person that has the call option? Well, remember, he has $100 cash, but he also has the call that has $1 worth of intrinsic value. So he has a call plus a bond that is also worth 101. But look at that. No matter what happens, both traders either end up with $100 cash if the stock is below the strike, or if the stock is above it, they both end up with exactly the same values, not just the changes, the values. And the reason this works, that these values will always equal each other, no matter where the stock is because of the addition of this bond. All right, that's what's keeping these portfolios completely equal. So let's go back to our table, and now let's track the total for the stock plus put portfolio and the total for the bond plus the 100 call. So with the stock at 85, notice that the stock plus put portfolio is worth 100, but over here, the $100 call plus the bond is also worth 100. See, now they are exactly equal. If the stock is 90, stock plus put position is worth 100. The $100 call plus the bond is worth 100. They are exactly equal. Stock's at 105. Stock plus put is worth 105. the call plus the bond is worth 105. Let's push it up even higher. Stock's at 115. Stock plus put is worth 115, and the call plus bond is worth 115. So do you see what's happening? There's a difference now that the value, the total value of both positions is identical. And when we set up a portfolio this way, or a synthetic, this is actually called a replicating portfolio. When we just had the call without the bond, remember it was called a mimicking portfolio. Now it's called a replicating, meaning that it is identical in value, and that's because of the addition of this bond. So the synthetic equivalent for a replicating portfolio is stock plus put minus call equals a bond. See, in the mimicking one, we said it equals 0. But now we're going to make it equal to a bond. Remember that the bond equals the exercise price. So now if we wanted to say what's a synthetic call, we would bring the call to the other side. We get stock plus put equals a bond plus a call. It does not just equal the call. So now we get a very interesting insight. And this is one of the reasons I love understanding these two types of synthetic formulas. So if we look on the left, we have stock plus put. That is insurance on top of stock. We look at this as an insured position. Look over on the right. See, if the call goes out worthless, at least we have the bond, providing that cash, the same amount of cash that this trader will have by exercising the put. So now the bond plus the call is also an insured position. But watch what happens when we go back to the mimicking portfolio where we don't have the bond. Let's take the bond out of it. Normally we say stock plus put equals a call. Well, now this isn't an insured call. This now turns to speculation. And so by understanding the two types of synthetic formulas, we can now answer the question, among many others. But are call options insured positions, or are they speculative? Well, it all comes down to how you set up the position. If you have cash on hand, and it doesn't have to be in a bond, but you need to have it in the account, and you're ready, willing, and able to buy the shares should the call option expire worthless, then you're using a call option as insurance. Conversely, if the call option expires in the money, you could use that cash to exercise the call and buy the stock, in which case you would be holding the shares just like the stock plus put portfolio. But if you're using the call option by itself and you have no other cash in the account to actually buy those shares, then that call option becomes speculative. So the main thing to take from this, like all aspects of options trading, really small nuances can make very big differences in the way that the positions behave or the way that you think they should behave. And so the better your understanding of synthetic positions, the better your understanding will be of options, strategies, and synthetics. And with better understanding comes better decisions, and that can only mean better outcomes. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.